In the next several days, Jerome Powell will hand over the Federal Reserve to Kevin Warsh. The handoff has been clearing the final political and procedural hurdles all month. The Department of Justice dropped its criminal probe of Powell on April 24th. Senator Thom Tillis lifted his hold on the Warsh confirmation on April 26th, and the Senate floor vote is now scheduled for the coming week. The political theater is over. The economic stakes begin the moment Warsh sits down. Because the last Federal Reserve chair to walk into a room with the exact configuration of crises Warsh will inherit was Arthur Burns in February of 1970. Burns inherited an inflation rate of 6.2%, an oil import dependency just beginning to spike, a sitting president demanding rate cuts, and a dollar whose convertibility into gold was about to be terminated. Warsh inherits an inflation rate of 4.4%, an oil supply chain disrupted by an active Middle East war, a sitting president who has openly demanded rate cuts for 15 consecutive months, and a dollar whose reserve currency status has fallen from 71% in 2000 to 56.8% according to the most recent IMF COFR data. The room is structurally similar. The chair is changing. Burns walked into that room with a PhD from Columbia, a long-term study of business cycles, and a friendship with Richard Nixon dating back to the 1950s. He walked out of that room 8 years later, having presided over the worst destruction of dollar purchasing power in modern American history. Between 1973 and 1980, the dollar lost approximately 60% of its purchasing power against a fixed basket of goods. The middle class did not vote for that loss. They lived inside the room while Burns made the decisions that produced it. Almost nobody walks the audience through what Burns actually did, decision by decision, in the language of the meeting transcripts that are now publicly available. That is what we are going to do. My name is Ban. I have been reconstructing the Burns Federal Reserve across 6 months of work using the FOMC meeting transcripts released under the Fed's 20 to 30-year publication rule, the Burns personal papers archived at the Gerald R. Ford Presidential Library in Ann Arbor, the Nixon White House tapes that captured Burns and Nixon discussing monetary policy in 1971 and 1972, the contemporaneous reporting in the New York Times and Wall Street Journal across the relevant trading sessions, and the academic reconstructions in Robert Hetzel's monograph, The Monetary Policy of the Federal Reserve, published by Cambridge University Press in 2008. I am going to walk you through the 4 decisions that defined the Burns era and the cumulative cost they produced for ordinary American savers. We are going to do this chronologically. We are going to do it in the language of the actual decisions, not the retrospective commentary. By the end of this video, you will have watched a Federal Reserve chair execute the wrong playbook in real time, and you will know precisely what the same playbook would look like if a new chair began executing it again starting next week. Subscribe to the channel before we continue, hit the like button, share this video with anyone who is asking what they should do before the new Fed chair takes office. The room Warsh is walking into is documented. The decisions that destroyed savings the last time are documented. The historical record exists. It is just not on cable news. The first decision, August 15, 1971. Sunday evening, Richard Nixon addresses the nation from the Oval Office and announces 3 things: a 90-day freeze on wages and prices, a 10% surcharge on imports, and the suspension of the dollar's convertibility into gold. The Bretton Woods system that had governed global finance since 1944 ends in a single televised speech. Burns does not appear on television that night. He does not need to. He had been consulted 3 days earlier at Camp David. The transcripts of that Camp David weekend, released decades later, show Burns arguing privately that closing the gold window was a mistake. He warned that it would set off uncontrollable inflation expectations. He was overruled. And then, having been overruled, he did something that defines the entire next 8 years of his chairmanship. He accommodated the policy he had just argued against. The Federal Reserve had a choice in August 1971. With the dollar's gold backing removed, the Fed could either tighten policy aggressively to substitute monetary discipline for the lost gold discipline, or it could ease policy to accommodate the wage price freeze that Nixon had imposed. Burns chose to ease. The federal funds rate fell from 5.57% in July to 4.5% by November. The money supply expanded at a 6.3% annualized pace in the second half of 1971. Burns later wrote in his personal papers that he believed the wage price controls would suppress measured inflation long enough to allow the easing to take effect without triggering a wage price spiral. He was wrong about that. And the reason he was wrong is the first lesson Warsh will need to internalize this week. Wage and price controls do not eliminate inflation. They suppress its measurement. The pressure builds underneath the suppression and releases violently when the controls are lifted. Burns eased into a system whose inflationary pressure was being artificially compressed. When Nixon let the controls expire in stages between 1972 and 1974, the suppressed pressure released directly into the Consumer Price Index. CPI inflation, which had been 4.4% at the start of 1972, reached 8.7% by the end of 1973. Burns had created the conditions for the second decision before he had to make it. The second decision, October 16, 1973. The Organization of the Petroleum Exporting Countries announces an oil embargo against the United States and a quadrupling of crude prices from approximately $3 per barrel to $12 per barrel. Burns convenes the Federal Open Market Committee on October 23. The transcripts, released in 2004, captured the committee's deliberation in real time. Burns frames the oil shock as a one-time price level adjustment rather than a sustained inflationary impulse. He argues that tightening monetary policy in response to the oil shock would convert a one-time adjustment into a recession without addressing the underlying supply problem. The committee accepts that framing. The federal funds rate, which had risen to 10.78% in September 1973 on the back of earlier tightening, is held there briefly and then begins a steady decline. By December 1974, the funds rate is below 7%. Burns has identified the oil shock as transitory and treated it accordingly. The actual outcome is documented. Inflation does not behave as a one-time adjustment. The oil price increase feeds through into transportation costs, manufacturing costs, food costs, heating costs, and ultimately wage demands as workers organize to recover lost real income. CPI inflation, which had reached 8.7% at the end of 1973, climbs to 12.3% by the end of 1974. The economy enters recession in November 1973 and stays in it through March 1975. Stagflation is born. The word itself enters mainstream economic discourse during this period. Burns has produced the condition that the textbooks said could not exist, simultaneously rising unemployment and rising inflation. His framework, which assumed the two moved in opposite directions, is structurally broken. He does not abandon it. The third decision, the cut into the recession. By early 1975, the unemployment rate has climbed from 4.9% in October 1973 to 9%. Burns is under intense political pressure from the Ford administration and from a Democratic Congress to ease aggressively. He does. The federal funds rate falls from 10.5% in July 1974 to 5.2% by May 1975. This is a 5.3 percentage point cut over 10 months in the middle of an inflation rate that is still over 9%. The real federal funds rate, the funds rate minus inflation, is deeply negative throughout 1975 and 1976. Real rates near negative 4% are not normal monetary policy. They are emergency policy. They tell every saver in the country that holding cash or short-term treasuries is guaranteed to lose purchasing power. Burns later defended this decision by arguing that the recession of 1973 to 1975 was severe enough to require aggressive easing regardless of the inflation backdrop. The Phillips curve framework he had inherited told him that high unemployment would cool inflation on its own. The framework was wrong. The unemployment rate did fall from 9% in May 1975 to 7% by mid-1977, but inflation did not cool. CPI inflation bottomed at 5.7% in 1976 and then began rising again, reaching 6.7% by the end of 1977. The framework Burns was using had told him to ease, and the easing had not produced the cooling the framework predicted. By the time he handed the chair to G. William Miller in March 1978, the inflation rate was running at 7% and rising, and the dollar was already in serious trouble. The fourth decision, the decision Burns did not make and which his successor inherited. Between March 1978, when Burns left, and August 1979, when Paul Volcker became chair, G. William Miller continued the Burns framework with even less rigor. The federal funds rate was raised from 6.7% at Miller's appointment to 10.7% by his departure, but inflation rose faster than the funds rate did, leaving real rates negative throughout his tenure. By July 1979, CPI inflation had reached 11.3%. The dollar was collapsing. Gold, which had been freed from its $35 peg in August 1971, was trading at approximately $300 per ounce in mid-1979 on its way to the $850 peak in January 1980. Volcker took office on August 6, 1979, and began the tightening cycle that would eventually break the inflation Burns had created. The federal funds rate reached 20% by the end of 1980. The recession that followed was the deepest since the Great Depression. Unemployment reached 10.8% in 1982. Inflation finally broke. By 1983, CPI inflation was below 4%. The cost of breaking the Burns inflation was paid by the workers, savers, and businesses who lived through the Volcker recession. The cost of creating the Burns inflation had been paid by the same constituencies in different form throughout the previous decade. The cumulative impact on a saver who held dollars in a passbook savings account through the entire period 1973 to 1980 was a loss of approximately 60% of purchasing power against a fixed basket of consumer goods. Two-thirds of a working lifetime's accumulated savings evaporated into the gap between the regulated 5.5% passbook ceiling and the actual inflation rate. The middle class did not vote for that destruction. They lived inside the room while Burns made the decisions.
Now here is the part the cable news coverage of the Powell to Warsh transition will not include. The internal Federal Reserve Board memos released under the same 20-30-year publication rule that released the FOMC transcripts contain a specific and almost unbelievable document. In April 1974, 6 months after the oil shock, the board's Division of Research and Statistics produced an internal memorandum titled Alternative Monetary Strategies that explicitly modeled the trade-off between aggressive tightening to break inflation expectations early versus accommodative easing to support employment. The memo's conclusion, in language that has since been reproduced in academic monographs, was that aggressive tightening in 1974 would have produced a recession lasting approximately 12 to 18 months and would have broken inflation expectations before they became entrenched. The memo's recommendation was therefore aggressive tightening. Burns received the memo. The deliberation around it is captured in the FOMC transcripts of May 1974. Burns rejected the recommendation. The reason he gave in the transcript was that he did not believe the political system would tolerate a deliberate recession imposed by the Federal Reserve. He believed, correctly, that the Ford administration would not back him publicly if he raised rates aggressively into a deteriorating economy. He believed, correctly, that Congress would investigate him. So he chose the framework that protected the Federal Reserve's institutional position from political backlash, at the cost of imposing the Volcker recession on the next generation. The arithmetic embedded in that institutional choice is worth pausing on. The memo's 12 to 18-month projected recession, had it been imposed in 1974, would have produced an estimated peak unemployment rate of approximately 7.5%, meaningfully higher than the cyclical level, but well below the 10.8% unemployment Volcker actually had to impose to break entrenched expectations 5 years later. The shorter recession would have been less severe than the one that ultimately occurred. The savings preserved across the 70s would have dwarfed the wages lost in the shorter recession. Burns understood the trade-off. He chose against it. The political calculus he applied was not unique to him. Every Federal Reserve chair since Burns has faced some version of the same choice in some form. The structural answer the institution reaches for in the absence of an explicit external mandate to do otherwise is the answer that protects the institution from immediate political backlash, even when that answer guarantees larger costs distributed across the population over a longer horizon. The decision is rational from the institution's perspective. It is catastrophic for the savers, whose accumulated capital is the buffer absorbing the deferred cost. The memo exists. It is publicly available at the Federal Reserve. Less than a few thousand researchers have ever read it. Your financial advisor has not read it. Your congressman has not read it. The mainstream financial press has not summarized it during the current Powell to Warsh transition. The document tells you that Burns was not unaware of the alternative.
He chose the alternative the political system favored. Warsh will receive his own version of that memo within his first year. The Federal Reserve's Division of Research and Statistics still exists. It still produces internal memos modeling alternative monetary strategies. The next memo will land on Warsh's desk with similar projections. Aggressive tightening would impose a sharper near-term recession and would protect long-term purchasing power. Accommodative easing would defer the recession and would impose larger cumulative losses on savers across the next decade. Whether he chooses Burns's path or Volcker's path is the variable that determines what the next decade looks like for every saver in the country. The choice is not technical, it is institutional. The framework that produces the choice is the framework you can position around now before the choice is made. So what does the historical record say a saver should do in a room that looks structurally like the room Burns walked into? The two specific numbers to watch instead of the daily Fed funds rate or the daily inflation print are the 10-year Treasury inflation-protected security yield, currently at approximately 1.8% and retreating from a March peak of 2.13%, and the trimmed mean inflation rate published by the Cleveland Fed Bank of Cleveland, currently at approximately 3.6%. The TIPS yield is the single best real-time indicator of whether the Fed is running real rates positive or negative. When real rates run positive, savers can hold short-duration Treasury bills and preserve purchasing power. When real rates run negative, as they did throughout the Burns era and as they did from 2020 to 2023, every dollar held in cash or short-duration Treasuries loses purchasing power on a guaranteed basis. The Cleveland Fed's trimmed mean measure strips out the most volatile categories and shows the underlying inflation trend more accurately than the headline CPI. It is the measure the FOMC actually uses internally. It is publicly available at clevelandfed.org. It is updated monthly. Both numbers are free. Both are not on Yahoo Finance's default chart for any ticker. Watch them. For instruments inside an individual retirement account, the historical record across the Burns era favors a barbell. On the gold side, 4 vehicles. SPDR Gold Shares, ticker GLD, is the largest physically backed gold exchange-traded fund with approximately $150 billion under management and the deepest liquidity of any gold vehicle. iShares Gold Trust, ticker IAU, is mechanically nearly identical to GLD with a lower expense ratio of approximately 25 basis points versus 40 for GLD. Aberdeen Standard Physical Gold Shares, ticker AAUU, holds physical gold in vaults outside the banking system. Van Eck Gold Miners, ticker GDX, is the leveraged play. During the 2008 to 2011 cycle completion, GDX gained over 200%, while gold itself moved 159%. All 4 are eligible for traditional and Roth IRAs without structural complication. Held inside a Roth IRA, the gain is never taxed at all. Held in a taxable brokerage account, the gain faces collectibles taxation at 28% maximum federal rate. The IRA wrapper matters. On the short-duration Treasury side, 2 specific vehicles for the savers who lived through the Burns era and want to position for the Warsh era without taking interest rate duration risk. iShares 1 to 3-year Treasury Bond ETF, ticker SHY, holds Treasury notes with maturities between 1 and 3 years. The fund's average duration is approximately 1.8 years, meaning a 1% rise in interest rates produces approximately 1.8% decline in the fund's price, a manageable risk versus the 8 to 10% decline that long-duration Treasury funds experienced during the recent rate hiking cycle. SYA produces yield without the duration risk that destroyed long bond investors in 1979 through 1981. SPDR Bloomberg 1 to 3 month T-Bill ETF, ticker BIL, holds Treasury bills maturing in 1 to 3 months. effectively a cash equivalent, yields the prevailing Treasury bill rate with effectively zero duration risk. For investors who want to hold dry powder during the early phase of a Warsh chairmanship without committing to long-duration bonds, BIL is the institutional cash vehicle. Better still for some investors is SGOV, the iShares 0 to 3-month Treasury bond ETF, which carries a slightly lower expense ratio and similar mechanics. The barbell approach, gold on one side, short-duration treasuries on the other, with no exposure to long-duration bonds, is the structural allocation that historically protected purchasing power across the Burns era. Long-duration bonds were the asset class that lost the most. A retiree who held 30-year treasury bonds bought in 1973 lost approximately 70% of purchasing power by 1981. Short-duration treasuries lost some purchasing power, but recovered as rates rose and they were rolled into higher-yielding successors. Gold gained 900%. The barbell, rebalanced annually, would have substantially preserved purchasing power across the entire decade. The framework is not new. It is documented. It worked. It has not been promoted because it does not pay advisor fees. Warsh walks into the room this week. The room contains an inflation rate that has stabilized but not returned to target, an oil shock that has not fully resolved, a sitting president who has demanded rate cuts for 15 consecutive months, and a dollar whose reserve status is structurally weaker than at any point since 1971. Burns walked into a similar room in 1970 and made the 4 decisions we have walked through. The cumulative cost of those 4 decisions to the American middle class was approximately 60% of purchasing power between 1973 and 1980. The Volcker correction that followed broke the inflation, but the savings destroyed during the Burns era were not recovered. They were gone. Warsh now sits in the same chair. The political pressure is the same. The framework choices are the same. The memo equivalent, the internal Fed research that lays out the alternative, will arrive on his desk within the year. Whether he chooses the path that protects the institution from political backlash, as Burns did, or the path that imposes the necessary recession, as Volcker eventually did, is the variable that determines what the next decade looks like for every saver in the country. The historical record is documented. The decisions Burns made are in the transcripts. The cost his decisions imposed on ordinary Americans is in the inflation series. The room is the same. The chair is changing. What you do this week before Warsh's first FOMC meeting is the only variable you control. This is BAN. The room is the same. The chair is changing.